Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good to have you back on.
Happy to be here.
Well, on Wall Street, the pressure continued Wednesday on the big tech stocks, and Fed Chair Powell telling Congress, though, that there are no plans to raise rates. In Seoul, stocks plunged today on several issues, it seems. So what's the story in the global and the Korean markets?
Okay, well, the U.S. markets, as you mentioned, were mixed. So was the European market. They were mostly down except for FTSE today. Now, note that these markets have closed, at least on Korean time, yesterday. Asian markets, which opened today, all experienced significant losses. Nikkei, Shanghai, Hang Seng, as well as Kospi and Kosdaq all experienced losses. Kospi went below 3,000 today. And the Kospi fall was triggered by foreigners selling, probably because of the fall in the Chinese market. Now, as you mentioned, Powell did say that he was committed to maintaining low interest rates. That is usually a very good news for stock markets. It should have gone up, but he has been repeating for months that he will allow inflation higher than 2% to continue for a while until the employment picture in the United States looks better, and that might be spooking the stock markets as well as other asset markets, because not only stocks but other assets experienced significant loss in the last couple of days.
Right. Potential inflation there is a concern of many people. Now, another story in Korea. Last year, credit extended to households rose by around 126 trillion won, call it $110 billion. This is the biggest increase in 4 years, and it doesn't look like rates on deposits are going up, only rates on borrowing. So what do you make of the situation, Professor?
Okay, well, it has two aspects. One, for the higher income people, they're using the low interest rates as an opportunity to borrow at a cheap rate to speculate, invest in housing, stock, Bitcoin, so on and so on. And on the housing, even though there are restrictions on housing-related loans, I think a lot of people feel that this is the best opportunity for them to buy housing because the interest rates are so low. Now, the problematic part is the lower income people are also borrowing at a low interest rate, but they're borrowing money to survive. And the higher income people will probably be able to pay the money back, but the lower income people may not be able to, and that's going to become a social problem in the future. Also, another potential problem is that this high debt load means that if the interest rate goes up, even if the coronavirus is defeated, it will take longer to get back to normality because of the debt load. People will be less willing to spend, and if people are less willing to spend, it's going to take longer for the recovery to take place. The ultimate solution to controlling the household debt is to raise the interest rate, even though people who have borrowed may have difficulty repaying. But right now, both for political and economic reasons, interest rates are probably not going to go up in the near future.
So it could be a tricky way out of this in many respects, Professor. Thanks so much for sharing your insights with us today. We appreciate it, as always.
Thank you.